Started. I meant to get started a few minutes ago, but we're here. What a day. When I saw what happened today, when I saw some of the news reports that came out today, I really, I have to say, I literally thought to myself, holy shit, this is serious. Wow. I mean, if you had any doubt that the Fed was going to jack up interest rates and fight inflation aggressively, those doubts have been removed. The Fed has basically said it's all in, it's all geared up, all warriored out, and the Fed is going to fight inflation. It's going to fight raising rates and letting its balance sheet run off really fast, way fast. This is going to really slow things down. And, it takes time for inflation to slow down. So the Fed's got to be aggressive now. And you won't even see the results of what it does to inflation in terms of slowing it down for maybe another 6 to 12 months. Okay. Maybe a little sooner, let's say 6 months, but that's usually the range. It takes time for Fed policy to work its way through the economy. So we have a lot to go over today. And is, I think today, Uh, I think today, based on the news, is one of the most significant days of this year. We're going to look back and say that day was the day we knew we had our last chance to get our portfolio in shape, to sell what we had to sell, to get rid of any junk out of our, to eliminate any junk in the portfolio. Today, it was that day. And I think if you're looking to speculate on um, recoveries of stocks that were super hot during the pandemic that have cratered and they've been getting hot lately. We talked about this yesterday. I think that's off the table because rising rates is not good for companies that are considered high duration, companies that are trading strictly on future earnings expectations that don't have earnings now. Yes, I know what you're going to say. Well, everything's based on future expectations, but it's one thing to have cash flow and earnings now and expect that to grow, as opposed to have no cash flow and no earnings now and even burning through cash and expect that to turn around one day. I think the conditions for that um, have been removed, and I don't think there's a shot that they're coming back anytime soon. This is like such a serious day. So let's get into it. I'm going to tell you why. Let's put up a banner. You're watching Be the Boss of Your Money. This is my live stream. We do this every day at 4:30. It's all about the stock market, investing, personal finance, planning, college, etc. These are the things that you need to know. These are the things we're going to talk about in personal finance that you wish you knew when you were in high school. These are the things you need to know so that you could potentially make the most informed decisions possible for your financial future. Let's roll the quick intro. And we've got a couple of things to talk about. I just got to say one time real quick. I'm surprised the stock market wasn't down a lot more today. Here we go. All right, we're back. Thank you very much for joining me. I see you guys out there. We've got a couple of things to take a look at. So stick with me for the next, let's say, 25 minutes. And while you're watching, if you have any questions, that's what the comments are for. I love hearing from you. If you have a point of view you'd like to share with us, express it in the comments. And if you disagree, that's awesome. I want to see why. I want to see what I'm missing. So let's hear it, folks. And if you have any words of wisdom, words of encouragement, or you just want to say hi, please do so in the comments. Give us a thumbs up, a heart, a celebration, whatever the reaction is, depending on which platform you're watching from. And then I will see who's out there. Today's a significant day because interest rates went up so much. It's always significant when you see interest rates rise the way they did today. It's not so much the amount, although the amount that interest rates went up today is pretty significant. What's really significant are the levels. The levels. I used to have a branch manager used to talk like that. Like you say, it's not the amount, it's the level. 2.5% plus on the 10-year treasury. That means all you folks out there investing in your bond funds and your bond ETFs, you are just getting absolutely smacked with those. They are down as much as the major stock market averages, like the S&P 500 index, if not more. By the way, you can't invest directly into the S&P 500 index, or any index for that matter, but you could invest in a security that tracks or mimics an index. Man, I could say that in my sleep, what a disclaimer. So you're not making it in stocks this year. You're not making it in bonds this year. You were making it in your energy a little bit, some of the commodities complex, but it's probably not enough to take over your entire portfolio. It's not enough of an impact. I have energy stocks in client accounts as well, and commodities related stocks in client accounts. It helps a little bit, but it doesn't make up for the rest of the portfolio that's going down, right? So we've got a couple people out there. We have our first comment. We have our first comment out there. Hey, Mitch, Carmine, so nice to hear from you. And brother Carmine, I really appreciate those nice messages you sent me on LinkedIn. The support means a lot. So you and I should meet in person one of these days. I work in Melville. I think you're in the area. I know you are somewhere in the vicinity of Melville. And if you're not from Long Island, Melville, especially the Route 110 corridor, we also call it Broad Hollow Road. That's the road I'm on. That's pretty much the business nerve center of Long Island. There's a lot in Hop Hog. There's a lot in Lake Success on Long Island, but Route 110 is really where it's at. I love working on Route 110. We've got restaurants. We've got office space. I don't know. I guess that's all we have. Should I love it that much? We used to have a driving range on 110, but that was closed and turned into retail space. Okay, you in East Northport. Okay, that's very close. I'm by East Northport all the time. All right, I'm looking forward to that. We got to do it. We have to do it. All right, so let's talk about this crazy day. And it really was an insane day from my point of view. Interest rates, a lot of people are thinking, oh, yeah, the 10-year yield hit 2.4%. And I heard the commentators, the pontificators, I heard all these people in the media. I'm not one of these people who's a media basher. I like the media. Okay. Yeah, I said it. I like the media. I think the media I watch is good stuff. All right. So there you go. But I watch a lot of different things. And by the way, I create media. You see, like I'm doing now, like I'm creating media. You just step in, just to say the word media in a live stream, you're opening up a can of worms. Forget I said anything. Okay. Let's just start all over. I still have this residual cough, but it's almost gone. I've been dealing with this cough for like 3 weeks now. A lot of people thinking 2.4% was the max we'd see for the year on the 10-year treasury. And now it is above 2.5%. And now you really have to agree that the rate looks to go higher. Looks more up than down. People are starting to get a little freaked out about defending their position of the highest will go in the 10-year treasury yield is 2.4%. Let me tell you what it means when the 10-year yield goes up. When the 10-year yield goes up, it means the cost of loans go up, interest rates go up, like the mortgage rate. 30-year mortgage rate today went above 5%. We closed the day above 5%. It did just like touch 5% for a second. It's over 5%. The average 30-year mortgage rate across the country. You could probably still get like a 4.8 or so around if you search around. You have excellent credit, putting a lot of money down. But basically, the 30-year yield, the 30-year rate on a mortgage is over 5%. First time since 2011. It did touch 5% like twice in 2018 for like a second, but that didn't last long. Now it does look to be persistently above 5%. And if you take a look at the higher yield and you take a look at that, home prices have risen for 20 months in a row. It's really expensive to buy a house. It's already been expensive, but it's even more expensive to buy a house. So most people in my orbit say, well, if interest rates go up, it has to drag down the price of houses. We'll see what happens. The dollar amount of a mortgage payment will be going up if you're applying for mortgage, and the bank might say, well, you could afford to spend $3,000 a month on your mortgage, but we have to cut you off at 3,500. Well, if the rates went up, you might be now having to put more money down on a house, and if you don't have the money, or if you don't want to put the money down, then you have to buy a different house, a less expensive house. We're going to see what this means for the housing market. The housing market, though, is so strong. It doesn't look like it's something that's just going to immediately turn around. If anything, it'll maybe slow down and go down a little bit. But I also have to think, if you were a seller of a home, you're selling your house and you've been sitting on your hands, always waiting for an even higher price because you got greedy. I'm talking to you predominantly, you baby boomers out there. You may have missed the top. I don't think you missed the boat, but you may have missed a lot, because now your buyers are coming to you saying, I know you think it's a seller's market, but whatever you think, we can't even get approved for a mortgage big enough to buy your house anymore because the rates went up so much. So, all right, take that. All right. Anyway, let me just start by saying this. Lael Brainard is the vice chair of the Federal Reserve. So she's the number two person. First, it's Jerome Powell. Almost said Ben Bernanke, but it's Jerome Powell, then Lael Brainard. And she came out and said, we are going to let our $9 trillion of Treasury and mortgage securities roll off pretty fast, maybe $100 billion or more per month, okay, of that money rolling off, going back, pulling money out of the economy and raising rates 0.5% at the next couple of Fed meetings. Okay. That is, and then Mary Daly, let me put this up on the screen for you. Okay. This is her. All right. I'm going to make this a little bigger. All right. She said central bank could start reducing its balance sheet as soon as May, and doing so at a rapid pace. Like that is like really hyperbolic language for what's considered a reserved position, being a Federal Reserve governor. So when they say rapid pace, you have to take them at their word. And she said that, we will have to be more aggressive than a quarter point. Lael Brainard, okay, she has been like the biggest dove, keeping rates low, cutting rates, quantitative easing. So when she comes out and says, we have to get aggressive, that is a scary thing for bond investors, a scary thing for stock investors, scary thing for the economy. Okay, not trying to scare you, but this is a bit of a freak out moment. Okay, see, Federal Reserve Governor Lael Brainard. Well, you can't even see that what I'm looking at. So and then let's go to the Fed's Mary Daly. Mary Daly is the governor of the Federal Reserve Bank branch of San Francisco. And she says inflation is as harmful as not having a job. And she said, if you had any lack of confidence at all about our ability and desire to fight inflation, let me correct you. We're fighting it. These are fighting words from two Fed governors that are historically pretty dovish. So you have Jerome Powell, okay? You have Lael Brainard, and now Mary Daly, all right? And she says, okay, which she says, Daly said the Fed will use its tools to combat inflation. If you don't have that confidence, let me give it to you. That's like, she is like, we are fighting this. I mean, it's such an aggressive posture from the Federal Reserve governors. It's so aggressive. I don't ever remember seeing Fed governors so aggressive in their choice of words. And I've been watching the Fed now for over 30 years. So it's really, to me, quite stunning. And this is why interest rates have gone up so much. So let's take a look here. Okay. I'm just giving you the headlines, but I'll explain it to you. 30-year fixed mortgage crosses 5%. That's pretty significant. A year ago, we were like, what, 3.3, 3.4% on the 30-year rate. Now we're 5%. So whatever you think a mortgage payment would be, it's going to be a lot higher than you expect. So if the dollar amount is too high and that dollar amount becomes too high of a percentage of your income and the ratio is higher than what a mortgage bank is comfortable with, they're going to say, no, we can't approve you for that particular house you're buying, especially when houses are appraising for less than the asking price of a house, which is very common these days. Okay. So let's take a look at how everything closed for the day. All right. So the Dow is down 280. I'm seriously, okay, telling you, I'm surprised the Dow is only down 280. I wouldn't be surprised to see the sell off follow through tomorrow. The Nasdaq got crushed down over 2.25%. S&P down 1.25%. Gold was off in spite of that. But well, if you're going to combat inflation, you expect gold to go down. Oil was down in the 10-year Treasury, 2.54%. The VIX shoots up above 21. Of course, when the VIX goes above 20, I expect a down market. Goes below 20, I expect an up market. This is well, I've become quite the concerned bear in the last few hours. Okay. Russell 2000 down over 2%. That's the Rust 2K right there. All right. Down there. So that really took a pretty big hit also. And let's take a look at bonds. One good thing today is as much as bond yields went up, the spread between the twos and the tens widen, and it's not inverted now, but the 2-year is 2.5% versus the 10-year, which is 2.55. So one's 2.52, one's 2.55. Okay. So at least the twos and the tens aren't inverted anymore. But what the Fed really looks at is it looks at the 3-month, which is 0.68, and the 10-year. And based on that, maybe we're not going into a recession, but that's the big call of the day. People are trying to decide, are we heading into a recession or not? Based on the aggressiveness of the Federal Reserve that we expect now to slow down the economy. Let me explain something. Let me explain this to you. Let me say it like this. Let me explain, please. You can't fight inflation without slowing down the economy. And if you fight inflation too vigorously, then you slow down the economy too much, in which case the economy rolls over. So the economy rolls over and goes into recession. Are we going into recession or not? I think there were a lot of people who were saying, well, we probably won't go into a recession because the economy has so much firepower, so much escape velocity, and the Fed wants to engineer a soft landing. But a soft landing is if the Fed could slow the economy down enough to tamp down inflation without sending the economy into a recession. But if the Federal Reserve is going to be so aggressive, you start to lose confidence in its ability for a soft landing. So what would you rather have? Persistently high inflation or a recession that cures the inflation? They're both bad, but having persistently high inflation long term is going to be worse than a recession over the near term. When could we have a recession? Look, I remember in 2007 when the recession started, the Great Recession, I remember in 2000 when we had a recession. I've been in the industry since 90. I've seen a number of recessions. And let me tell you, the economy was always in pretty good shape before the recession. It's tough to say when we could have a recession. Is it the second quarter this year? Well, we're in the second quarter this year. Third quarter, fourth quarter, maybe early 2023. Your guess is as good as mine. And I don't think it's really that important to predict whether if we have a recession in 6 months or 9 months or 12 months, or if we just have a general slowdown in the economy. But if the Fed raises rates and mortgage rates go up and rates on everything else goes up for borrowers, it means you have to put more money toward your purchases. Your car payment will be higher, your housing payment will be higher, your rent will go up, everything. That means you have less money for other things. You'll buy less stuff, spend less money on services, maybe cancel vacations. We could see the price of oil come down. That would be a help. We could see the employment picture weaken. And I know this, if inflation is sky high and the Fed tamps down inflation, it's going to hurt the economy. And then if we see unemployment rise, well, that's not palatable to incumbent politicians either. So I'm thinking in terms of like the Biden administration, they don't want high inflation, but they don't want a recession. They want to get it just right. And that's the problem. I don't think there's enough time to get it just right. We've got to really march fast and tamp down inflation before it becomes grounded in people's psyche where people just expect higher prices. All right. So there's a lot to dissect here. Let's take a look at some of the interesting stocks here. Boeing, the worst of the industrials, down 8.5. That is just such a disappointment. Cummins Engines is down. What was up? You had a few, very little was up in the industrials. Okay. Honeywell down 1%. The good stuff. UPS down 3.9%, under $200. Wow, UPS under 200. Southwest Airlines started to get a lift, no pun intended, back to 45. I bet you that could be, well, we'll see what happens. Based on the current trend, not looking good though. Okay. How about that? Am I allowed to say that? I think so. So let's take a look at the FANG M stocks. Okay, so Apple down almost 2%, Amazon down 2.5%, Facebook down almost 1%, Google, Microsoft, Nvidia down over 5%. I mean, you can't really have a stock market that goes up when these 5 stocks are down because they're the biggest. So, they have a huge sway over the performance of the major averages just because of their size. Okay. And let's take a look at some of the winners out here. Let's take a look at consumer staples. Consumer staples typically are considered late cycle companies. Okay. So let me explain that. Consumer staple stocks are often considered late cycle companies. So when you're late in the economic cycle, it means it starts like this. The economic cycle starts after the recession. You go into economic recovery, and economically sensitive stocks go up, and then you get into a longer lasting economic expansion. And what that means is the growth of the economy isn't as strong, but it's still growing. And based on that, a slower rate of growth, it makes companies with steady earnings, steady cash flow, steady growth look more attractive to investors. You often find that in consumer staples like food, toilet paper, things like that, and healthcare. And those late cycle stocks like food, healthcare, they're doing well, but it's not necessarily a good indicator for the medium-term prospects of the stock market and the economy. All right, people are buying those because they're worried about a slowdown in the economy, not because they're bullish on the economy. Okay, so I'm like Walmart was up, Kellogg was, Hershey's. I'm not going to give you every name. Pepsi was up, Costco is up, but a lot of the consumer staples were up. All right. So these are the things that I'm looking at. I hope this helps you with your understanding of the market. But ultimately, whatever it does, don't play games with it like this. I think, ooh, I'm going to get out of the market, and when the market's done going down, I'm going to get back in. Never works, folks, because it happens as if the market goes down, you'll say to yourself, well, oh, wait till it goes even lower. And then the market recovers a little bit, and you say, well, I could have bought when the stock market was lower. Wait till it goes lower. And then it goes lower, and then you say, well, now I think it's going to go even lower, so I'm going to wait. And then it goes up a little bit, and you say, well, I could have had it lower. I'm going to wait. And it goes up even more, and you say, well, now it's up too much. I'm going to wait till it goes down. And it goes down, you say, I'm going to wait till it goes lower. It becomes endless procrastination. And to me, your best bet is to keep investing, dollar cost averaging, like in your 401k plan. Stay diversified between large cap, mid cap, small cap, international, etc. Diversification is a strategy that we use to help mitigate risk. It doesn't necessarily protect your portfolio from going down in the generally down market, but it does keep you on the straight and narrow in a number of ways. It can help your portfolio recover, and it could help your portfolio smooth that volatility over time, because different asset classes in your portfolio could do well at different times in an economic cycle. So while some investments zig, some zag, and that helps smooth out volatility as opposed to just putting all the money into just one fund and just riding it way up or riding it down. Question for you. Do you know how I judge whether or not I'm doing well for my investment portfolio and for my clients' investment portfolios? It's kind of like a trick question. And I say it's like a trick question because it's not what you'd expect. You would probably say, I'm doing well with my client portfolios or for myself if my accounts are up. Well, they're up, so you're doing well. So does that mean if my accounts are down, I'm not doing well? Because if that's how you judge if you're doing well or not, you're going to be disappointed an awful lot of the time in your investing career, and you're not going to have the stick-to-itiveness or the mental staying power to stay invested through thick and thin, through ups and downs, and that's critical. So here's the answer. I know I'm doing well for myself and for my clients' accounts when we consistently invest, consistently stay diversified, and we consistently stick to our strategy. If you're doing that, then the market going up or down has nothing to do with whether or not you're doing well with your investment portfolio. That is a very big difference in thinking. It's a view that I wish I had when I was 24. I'm 54 now, but it's my view now, and I see why it makes so much sense. It's been my view for decades, by the way. But the key is, you know you're doing well when you're being consistent, not you don't get into this mistake of being caught up in thinking you're doing well or not based on how the market's doing. So if the market's doing poorly for 6 months or a year, that means you've got a bad portfolio and you should change everything. That's not what we want to do here. Okay. We want to control what we can control. A couple of the things we can control: expenses, expense ratios, dollar cost averaging, rebalancing, investing a comfortable dollar amount every month, month in, month out. If you can control those things and stick to those things that you can control, that's how you know you're doing well with your portfolio. It has nothing to do with the short-term performance of whether or not your brokerage account is up or down, or whether or not your 401k plan is up or down. That's my story. I'm sticking with it. Thanks so much for watching. I'll be back tomorrow. Have a great night.